Hey guys, Alessio, hope you're well. In this video, I want to talk about this particular chart you're seeing here, this data, and what it potentially means for the markets and maybe the economy as well. And also have a quick look at the chart of the stock market as well and give you my thoughts on it. All right guys, join me. Hey guys, welcome back. So as you can probably guess, I'm not in the UK anymore. I'm currently in Tampa, Florida. It's actually my first time to Tampa in Florida. I flew here just recently. An amazing view, by the way, from the airplane when you look down. Anyway guys, I want to talk to you briefly about some important data that came out. As I'm sure you probably heard, the US economy contracted in the first quarter of this year. So in the first 3 months this year, the US economy contracted. Now, as I'm sure you know, this by itself does not mean that the US economy has fallen into recession. As you know, we need 2 consecutive negative quarters before we can say the economy has fallen into recession. As yet, this has not happened. So if, let's say in the next 3 months, if in the next quarter, we have another contraction, we have another contracting quarter or another negative GDP reading, then we could say with a high probability that the US economy has fallen into recession. So we had in the previous quarter a negative GDP, and if we have another negative GDP in the next quarter, that would increase the likelihood that we're falling into recession. Now, as I'm sure you're aware, a lot of the news media, they're blaming President Trump for what's happened in the negative GDP numbers. In other words, they're saying, well, because President Trump came out with these highly unpopular tariffs, well, that's what's caused, in their view, the news media's view, that the US economy has gone into contraction, and that's one of the reasons why we might fall into recession. However, as I'm sure you're aware, even back as far as December of last year, we were warning that the economy could fall into recession. If you remember what I said back in December of last year, you may remember what I actually warned when I was here in the US at the time. I'll put a brief clip for you so you can have a look. The 3-month versus 10-year yield curve, which had inverted some time ago, I believe it inverted back in 2022, has now uninverted. And you're probably wondering, well, so what? Well, here's the thing, guys. Firstly, Manuel Bly says that whenever there's been an uninversion of the yield curve, as per the 3-month to 10-year yield curve, there has been a recession about 6 to 18 months later. Okay, so 6 to 18 months later, after an uninversion of the yield curve, as per this chart, usually a recession, an economic downturn follows. All right, guys, as you heard, back in December of last year, I said because the uninversion of the yield curve, well, usually when that happens, typically a recession follows within 12 to 18 months, or about a year or so afterward. And by the way, that warning I gave in December occurred when the market was much higher. So in other words, the uninversion of the yield curve, which by the way is courtesy of Manuel Bly, this chart you're seeing here, again, that was an early warning sign, much sooner than the tariffs. I mean, before the tariffs even occurred, that the US economy could fall into recession. And again, let's remember, it is by no means confirmed, it is by no means a certainty that the economy in the US is going to fall into recession. It's a probability, but it's not a certainty or guarantee. By the way, guys, before we continue, I just want to mention quickly that if you're looking for a fast and reliable trading platform, look into Radex Markets, our sponsor for this video. With Radex, you can trade stock market indices, individual stocks, cryptocurrencies like Bitcoin, Ethereum, gold, precious metals, and so on and so on. So I'll put the link for Radex in the description. Go ahead and check it out. As I mentioned before, guys, any money we get from sponsors, we get to charity. Let me also mention this particular chart here of the S&P. The S&P, the stock markets, as I'm sure you know, have had a nice rally. We've seen a nice bounce in the stock markets. A bounce and a rally, which we anticipated, we expected. If you recall my earlier videos from some weeks ago, you may remember as the big drop occurred, as the big crash occurred in the stock markets, I was saying very likely we've seen capitulation in the stock market and a likely bounce and rally in the major markets. Here's the clip. Bottom line is that the markets are becoming so extremely oversold that the probability is now increasing for a strong bounce. And I should say that the next major rally and bounce in the stock market could very well come back up and fill this gap here at near 5,400. That's an open chart gap. And indeed the one here at 5,600. The fear and greed index, as per this data, dropped to 4, what's called a capitulation indicator. And what that shows is that the stock market, the S&P, just fell to a region of capitulation here, below the minus 4.25 region there. And according to Jason, whenever this happens, this typically shows an extreme oversold condition, which exemplifies, in other words, it indicates potential capitulation in the stock market. All right, guys, as you heard, in early April, when the markets were lower, we were expecting and anticipating a nice bounce to fill the gaps on the charts, to fill 2 gaps on the charts, by the way, and a nice rally to the expected levels we've now come up to. Then a likely bounce and a rally into
this region here. As mentioned, close the gap at 55.71 and move into 56.46 and potentially even into this region. So that's the yellow scenario, which I think at the moment carries a higher probability.
If you remember, guys, when the market collapsed in early April, you saw the fear and greed index, the sentiment readings, collapsed to 4, suggesting a high level of fear and panic, which typically occurs right near capitulation levels. So it's not surprising the market bounced so strongly because, again, the levels of fear was so high. But here's the thing, guys, the market just recently came up to an important level of resistance. So for example, we came up to this level of resistance, 61.8% golden ratio retracement of the decline. So if you measure that decline of the stock market from the highs to the lows, the golden ratio 61.8% level, the Fibonacci level, comes up to that level you see right there, the red line. And that's the level we just came up to. We're just above that level as I'm making this video. So in other words, guys, this rally and bounce from the capitulation levels on the stock market has come up to levels we expected, we anticipated. By the way, most people in the news media and I would say social media did not expect this bounce and rally. Most analysts and YouTubers on social media and news media were very bearish. They were expecting the market to fall even lower. But again, we were going against the herd, we were going against the majority opinion out there, and we're saying no, we've reached capitulation and we could see a nice bounce and rally, and indeed we did see a nice bounce and rally as expected on the markets. But I think we should be very careful here, guys. I think a pullback is likely in the next, potentially in the next few weeks, maybe sooner. We could see a nice pullback from this rally. So we've seen a nice bounce and rally, but I think some kind of a pullback is likely. Okay, and this is important. That pullback, that next drop in the market, must stay above the prior lows, the recent panic lows of the market. I'll give you my own personal opinion, by the way, guys. My own personal view is the market bottomed. As I said at the time, I think we've seen capitulation and a very likely bottom has formed in the market. So my own personal view is a lot of data, and in fact Manuel Bly also mentioned this as well. A lot of the data, and also data from Manuel Bly, the DowTheory.com, suggests that we've likely bottomed at the panic lows of April in the major stock markets. Of course, that could be wrong, but I think the higher probability is that the bottom is in, as we expected, after the strong drop in capitulation. As quite expected, we've seen a nice bounce. So personally, I think the next pullback, I'm expecting the pullback to stay above the panic lows, above the major lows. So I'm not expecting those lows of April to be taken out. I think we'll stay above that. I think we'll stay above those levels despite any drops that may occur. So my own personal view is, despite any pullbacks that may occur in the next few weeks, I think the rally in the market quite likely and probably will continue, again, based on the balance of probabilities. Not a certainty, I could be wrong about that, but again, for the long term, I'm remaining bullish and positive on the stock markets, despite any pullbacks that may occur. All right, guys, and we'll see what happens to the GDP numbers in the next quarter. Should be quite interesting to see if we get another negative contraction to potentially put us into recession or not. We'll see. All right, guys, so from here in Tampa, Florida, I want to wish you a fantastic week. Thank you very much indeed. I'll see you guys in the next video update.